What's up? I'm Dan Fredenberg, and this is another Chance Encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house. It's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined today with Jay Scott. How you doing today, Jay?
I'm doing great, Dan. Thanks for having me.
Oh, it's my pleasure. And I got some great news for you, Jay. My very favorite audience member is joining us today. And why is my favorite audience member here? Well, it's because this is a chance encounter where I interview commercial real estate syndicators, investors, KPs, owners, operators, buyers, sellers, all that kind of stuff. And you may ask, why would I do such a silly thing? Well, if you've ever heard of private, off market, or 506B deals, you'll find out that you need to have a documented prior substantive relationship, or else you can't share those deals. And so that's what I'm up to. And at the same time, I'm helping you effectively communicate on the subject of a commercial deal and understanding how my guest fits into those. But before we get too excited about the deal part, Jay, do you want to say a thing or two about yourself?
I am a reformed engineer and business guy. Spent most of my career in the tech world, in Silicon Valley. Have an MBA. 2008, dropped out of the tech game with my wife. Fell into real estate and have been in real estate for the last 15 years.
I love it. I love it. And so that brings us to our first segment here. It's about the distinct motivations. Before that, though, I got to say, but wait, check your eight. Jay, I don't know if you can see through the camera and into the user's device down there, but there might be this hideous subscribe button that they really should probably, okay, it's a silly joke. I'll just,
As my kids would say, smash that subscribe button.
exactly. Smash that. All right, cool. So the five distinct motivations. Now, I've talked to all sorts of different players in the commercial real estate space, different investors, operators, and whatnot. And everybody has their own unique reason why they're involved in all this. But we need to know what that is precisely, just because these deals, they take months. There are plenty of risks involved. And so we need to make sure that anybody who gets involved in them will actually follow through with it. And I found that regardless of what your unique why is, they fit pretty neatly into these five categories. So let's go through them. The first one, preservation of purchasing power. What's that all about? Well, if you have a portfolio of assets and the profits from those assets are how you make ends meet, the only reason you're really going to, there's two reasons why you're going to make a new acquisition. One is if inflation eats away from the purchasing power of your cash flow. The other one is if you can buy at a steep discount, like if there's an asset crash or other forms of distress. That's not where I'm at personally. Where I'm at is trading time for wealth. Jay, you mentioned your tech background. I'm similarly, I was in the CRM industry, and I ended up building online funnels with those CRMs with my agency that I started up, and I got into real estate in 2014, working for a firm that flipped 10 houses a month. And when I was looking at my tax bill and I saw what my boss was making, I was going like, well, wait a second, how can I pivot to where I'm getting rewarded in the form of deployed capital, aka wealth, rather than in a high salary, high wage, and then paying half to taxes. So that's what I'm up to. But a lot of people, especially newbies, they're attracted to commercial real estate because they see these great big numbers in these transactions. They're like, if I could just get a sliver of that, it'd totally change my life. And really what they're after for, if you think, ends and means, is to take control of their schedule. Maybe it means they want to retire early. Maybe it means they want to work fewer months per year or fewer weeks per month. But regardless, that's what some people want to do. The next group, they're just plain ambitious. They want to buy their entire hometown. They're after that generational wealth to make sure that their great grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. That makes them fantastic members of a GP team because you need to stick with it. You have to have that follow through. Now, the last motivation I have here, though, it's similar to that. You're going to keep going even after your retirement age, as society says. But this group here, they've picked a sector of society, or maybe it's animals, the environment, or sending people to space. Who knows what it is? But the important thing is there's a financial aspect to having those big kinds of ideas or groups of people you want to help. And that's why they're making their acquisitions. So Jay, as far as you go though, of those 5 different motivations, what combination of those would you say describes you best?
It's almost all of them. It's at least 4 out of the 5. So certainly a lot of why we invest passively these days is wealth preservation. We like to grow our capital, but we all know that inflation has been trending up over the last year or two. We don't know what inflation is going to look like over the next decade, but I suspect it's going to be higher than that 2% target that the Fed's setting. And so anytime we can kind of invest in an asset class that has good risk-adjusted returns, meaning the returns are commensurate with the risk expected from those investments, it's a great way to grow your wealth. But more importantly, it's a great way to at least preserve your wealth. So that's a big thing for me. But also trading time for wealth. That's a big one as well. I'm at that point in my life where I have a family and I very much want to be able to spend time with my kids. I have 2 teenagers. I only have a couple years left with them. And so I want to make the most of that time. But I also am looking at building generational wealth. I want my kids to be able to pursue their passions. I want them to be able to give back to the world. I want them to be able to focus on others, not just earning money for themselves. And they can do that best when they know that they have a backstop and that they don't need to worry as much about chasing money as much as doing what's good for the world. And then finally, yes, I'm very much getting close to that point in my life where I'm trying to figure out how I can start focusing more time on giving back, less time on building wealth and building generational wealth, because at some point my kids don't need that much, but there are plenty of people and there are plenty of causes out there that do. And so a lot of what my partner Ashley and I focus on these days is how can we give back both through our real estate investing, but also through the profits that we're generating through our real estate.
I love it. I love it. I love your caveats that you threw in there as well, because it goes right into the next question, which is a tolerance for risk assessment. Now, to give some background about this question, just so you know where it came from, it's not out of left field. If you've ever invested in a 506B deal, the securities attorneys that the issuer pays, they're going to insist that you fill out this form that has all these invasive financial questions. Quite frankly, you're going to reveal more about your financial situation than you know about your own parents' financial situation. But there was one question in that questionnaire that I wasn't satisfied with because I didn't think it gave a real actionable, understandable answer, and it had to do with risk. So I turned it into a fill in the blanks question. Here it goes. There are many popular investment asset classes, but I think blank is too risky. So Jay, it can be inside real estate, it can be outside real estate. What's too risky for you?
So it's a weird question because as a little bit of background, I'll answer the question, but as a little bit of background, I invest across a number of asset classes. I have a lot of my net worth in real estate, but I own 15 racehorses, which is a much higher risk profile than real estate. I'm an angel investor. I invest in tech businesses and small businesses. I even invest in a restaurant, which is probably the worst investment on the planet. So I do in many cases have a high risk tolerance. But for me, the question is, not just the risk, but the risk related to the return. I'm willing to accept high risk, assuming it comes along with high returns and assuming it fits into my portfolio. I think of what I own in a very much in a portfolio manner. And I want to know that I'm well diversified across risk and returns. So for me, there aren't too many things that are too risky as long as it's a relatively small part of my portfolio. So if I had to fill in the blank there, I would say the roulette wheel. is too risky.
So the slot machines, the
Yeah,
casinos,
I'd
yeah.
probably have to get into pure gambling before it gets too risky for me. But again, it has to be a relatively small percentage of my portfolio, and the returns, the potential returns, the risk adjusted returns would have to be sufficient for me. But assuming they are, then there's not too many asset classes that are too risky for me.
Right. Excellent. Excellent. I love that. And that brings me to this. This thing always kills me. It's my segue here, this subscribe sandwich for everybody to enjoy here. But it's the segue to the Dan Does Deals Commercial Core Competency Cube. It has the 6 different roles in a commercial deal, and you can get your own copy for free at dandoesdeals.com. And like a complete dummy, I don't even ask for your contact information, like your email address, and you should always ask for your contact information in return for your freebie. But for me, I want to make sure that you can just go to dandoesdeals.com, print out your own copy and practice with this, because I think if you're going to make it in this business, it's all going to hinge on your ability to express yourself and talk about commercial deals in a way that makes sense to everybody. And in every episode of Chance Encounters, I go through all 6 sides of the die, so that way you understand how my guest fits into this deal. So let's get started. A repositioner is an acquisitions person. So they're looking at a bunch of different properties and they're doing a bunch of paperwork. What's that paperwork, you may ask? Probably not. But anyway, the paperwork, they're going to underwrite the deal. And that means they're doing the math. They're doing the arithmetic. They're figuring out, first of all, is this property actually making the amount of money that the broker or seller claims it is? Because they might be playing fun games with the numbers. And the repositioner, a lot of people just call them investors, and they call these guys investors and those guys investors. But the repositioners are a little bit special because they've got the expertise to say, how can we make this property, how can we find more upside, more profits from this property? So the repositioner is figuring out how to change things, but there's one part of their job that's a little bit unintuitive, I suppose, which is the financier relations component. Talking to investors, talking to people who only deal with paper and money. They're not doing any work on properties. They have no duties, anything like that. They are the lenders. And the reason why repositioners have to have an extensive network of financiers is because if they can secure a more advantageous loan, that goes straight to the profitability of the business. So that's why the repositioners are constantly meeting financiers. But the more obvious spot as far as how to find more upside is to get into the operations and stop those Benjamins from going down the toilet. But of course, there's a lot more to operations than just unclogging toilets and collecting rent and mowing lawns and doing different maintenance like that. There's also a marketing component, and between my automation and my marketing and content creation history, that's where I tend to fit in on GP teams. But the main problem about trying to optimize from operations is frequently there's only so much you can do. So the repositioner will frequently get a contractor team involved to do a value add or renovation of the units. The idea being that if you make the units nicer, then the future resident will be more than happy to pay more in rent than the previous one. But you have to be super duper careful with the expenses of contractors and upgrading your units, because if you're gold plating the toilets, then you're not going to get a good return on investment. And if you have the problem that I have, I don't know if you know this about me, but I'm from the internet. So that means I need locals. I need boots on the ground, somebody who can be there in an hour or two, because categorically, that's not going to be me. I'd still be stuck in an airport in an hour or two. So I need to have people nearby who can make sure that the contractors are staying to schedule, they're not using substandard parts and whatnot, and same with the operations. But when the repositioner has found a property, let's say it's 350 units, let's say it's tens of millions of dollars, they're going to turn around to the financiers and say, hey, you don't happen to have, I don't know, tens of millions of dollars you want to lend us for this, do you? Well, there's going to be one question that I haven't answered yet, and many coaching programs, guru programs, they tend to gloss over it a little bit, which is they're going to say, who's your sponsor? Who's the KP? What's that all about? So in a hypothetical, let's say you are a physician or an attorney or an engineer, and you decide you and your group of friends, your circle of friends, are going to take over some local commercial properties. The thing that's going to stop you in your tracks is the banks will require that somebody in the fold has a similar asset. In other words, they already own a similar asset. And then on top of that, you also need a certain amount of liquidity. And then among the ownership team, you need a balance sheet of at least the amount of the loan. But if you have all of those pieces, you've got yourself a commercial real estate deal. So, Jay, I know that this is far from your first rodeo. Where on the die do you think you're going to be contributing to your next deals?
Yeah, so I contribute in three places on most of our deals. Number one, I am that spreadsheet jockey. I'm the guy that likes to sit in front of the computer and work the numbers and do the underwriting, and make sure that the numbers work for our investors. So the repositioner. Number two, the financier, not necessarily on the loan side, but the raising the other piece. So the lender will lend some percentage of the money that we need, but then we need the rest of the money to come from our investors. And so I am that guy that goes out and networks with investors and builds their trust and communicates information about our deals and raises money. And then finally, I am one of those people on my team that will sign on the loan, the KP, the sponsor. And so I contribute my net worth, my liquidity, and my experience to ensure that we can get the loan.
I love it. I love it. So that brings us to the buy box then. And when commercial investors are talking about what's your ideal property, what's your buy box, we're really asking about three main things. First one's geography. Where is it? That means which state, which county, possibly even which neighborhood. It's all going to matter. The second one is going to be the size. Now, most of my guests are in multifamily commercial real estate, in other words, apartment complexes. And the way that you define size generally in apartment complexes is by the unit count. It's important because you're going to have a completely different group taking over 5-unit apartment complexes compared to the 350, the 500 and up and whatever unit apartment complexes. So that size is definitely going to matter. But the third one is called class. And I got to admit, one of my pet peeves is I don't like it when one word means more than one completely separate things. So I separate the word class into condition and area. When you're talking about condition, it means how old is the building, how beat up is the building, how luxurious is the building? Does it have lots of fantastic amenities? Is it a great, desirable place to live? That's the condition. Now, when it comes to area, you're asking about the crime rate where the property is located, the school districts where the property is located. And then, of course, when they say location, 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 that's actually a code word for how many humans are going by that property in a given day. So are there lots of car traffic and foot traffic, or is it basically a dead zone in the middle of nowhere? But both the area and the condition are ranked the same way as in grade school, where you got A plus at the top and then A minus and B plus and so on. So as far as your buy box goes, Jay, what you looking for?
Yep. So in terms of location, we buy in several cities in Texas. Houston is kind of our bread and butter, but we also buy in Dallas, in Austin, and some of the secondary cities just south and between the three of those. We buy in a couple of the large cities in North Carolina, including Charlotte, and we buy in Atlanta, Georgia. So that's our buy box in terms of location. In terms of number of units, we target 150 units and above. The reason for that is we like to be able to put in place full-time management and maintenance staff. So we don't want to have to figure out a difficult part-time management solution for our properties. And at 150 units or so, we can afford to pay payroll and get people there full-time. And then in terms of class, we typically look for C plus through A minus properties in A or B locations. And then we add a third big thing or a fourth big thing to our buy box, which is vintage, the year the property was built. And we typically look about 1980 to 2010 for our properties.
All right, beautiful. So then the next question has to do with people. And I got to tell you, my favorite thing about commercial real estate is that because it's multifaceted, you've got these different roles in here, and really nobody is going to be all of these roles for any real amount of time. We tend to be really eager to give referrals, meet new people, help them build new teams. But at the same time, because we all have our own unique skill sets, we're better off helping some people more than others. Me personally, because of my CRM, automation, and marketing chops, The sponsors and KPs I am eager to talk to. And then the other one, because I'm from the internet, is of course the locals. Getting the boots on the ground is very important to me because that's the one role that I just absolutely can't fill. Jay, as far as you're concerned, I believe you generally do 506C deals, so you could even mention a specific if you wanted to, but B's you can't. But you can also mention, passive investors, financiers, and whatnot. But who's out there that you think you're disproportionately well suited to help?
Passive investors. So those folks that are looking to put their investments to work without having to put in a lot of time, energy, or decision making on their own, come talk to me.
All right, I love it. And the next thing is how to reach out. Me personally, I've got this distinctive last name, which makes me pretty easy to find, especially on LinkedIn, where I spend most of my social media time. So reaching out to me that way is a great way. But if you use your phone to scan this QR code, that sends you to the FAQs page of 506BME, which is the platform that I offer syndicators and investors to document their substantive relations, showing that they new level of sophistication, appetite for risk, and all that kind of stuff. And then I take care of all the IT and make sure that you got that all buttoned up. But Jay, if people want to reach out to you, what are the best ways to reach out?
Yeah, the best way is to take that name that you see in the bottom of my screen, Jay Scott, put a www dot in front of it and a .com after it. And that's the best way to reach me, www.jscott.com.
I love it. I love it. And then the last thing I have, it's actually not for you, Jay. It's for you in the audience. It's a public service announcement. If you've been watching this episode and you've been experiencing searing pains in your eyeballs and like migraine-like symptoms, I'm very confident it's the hideous subscribe button's fault. And you can just click on that for free and it's gone. Of course, I'm biased. I want people to click on it because if enough people do, then YouTube will start to pay for these videos instead of me. I think that would be amazing. But as far as the consequences for you, all it means is my videos may show up on your list of suggestions, but you can feel free to ignore those suggestions because I just really appreciate the fact that you spent this time with me. Just like Jay, I appreciate you joining me today. This has been great.
I appreciate the opportunity. Thanks, Dan.
Awesome. Thanks. Make sure you 506B me. Any syndicators, make sure you 506B me.
Hi.
Oh, hey. Yeah, here's my code. You got your QR code scanner? Okay. Yeah. Oh, yeah. Just hold it right in the square there. Okay, cool. And now you hit open in browser.
Okay.
Okay. Are you already logged into 506B me?
Yes.
Yeah. Okay, cool. Yeah. So there's my video. So now I'm already on your watch list. So when you get back to your hotel, you can find out what my core competencies are and my level of sophistication. Sound good?
Yeah.
I love your hat. Real estate's a scam. That's really funny.
Yeah.
Nice meeting you.
You too.
506B me, everybody.